Today, we're diving into three major economic trends shaking the U.S.: exploding debt, AI-led growth, and market instability, and how they're all deeply connected. This week, we're diving deep into the latest jobs report, dissecting the Federal Reserve's next potential moves, and exploring a surprising surge in the technology sector. Let's get right into the numbers. The Bureau of Labor Statistics just released its latest employment situation summary, and the figures are telling a complex story. The economy added 210,000 jobs last month, a figure that came in slightly below many analysts' expectations. While this might initially sound like a slowdown, it's crucial to look beyond the headline number. The unemployment rate actually fell to 3.9%, a new post-pandemic low. This suggests a tightening labor market where employers are competing more fiercely for a smaller pool of available workers. So, what does this mean? We're seeing significant wage growth, particularly in the leisure and hospitality sectors, as businesses offer higher pay to attract and retain staff. Average hourly earnings are up 4.8% year over year. While this is great news for workers' wallets, it's also a key driver of inflation, a topic that's on everyone's mind right now. The labor force participation rate, which measures the share of the population that is either working or actively looking for work, ticked up slightly to 62.4%. This is a positive sign, indicating that more people are feeling confident enough to re-enter the job market. However, it's still well below pre-pandemic levels, highlighting a persistent challenge in the economic recovery. We're keeping a close eye on this metric, as a full recovery depends on bringing more people back into the workforce. Now, all of this data feeds directly into the second major story of the week: the Federal Reserve's ongoing battle with inflation. With the Consumer Price Index, or CPI, showing prices rising at their fastest pace in decades, the pressure is on the central bank to act decisively. Last week's jobs report, with its strong wage growth figures, adds fuel to the fire. Fed Chair Jerome Powell has already signaled a more aggressive stance, suggesting that interest rate hikes are imminent. The market is now pricing in the first rate increase as early as March, with potentially 3 or 4 more to follow throughout the year. What does a rate hike actually do? In simple terms, it makes borrowing money more expensive for everyone, from individuals taking out a mortgage to corporations financing new projects. The goal is to cool down demand across the economy, which in turn should help to bring prices back under control. This is a delicate balancing act. If the Fed moves too quickly or too aggressively, it risks stifling economic growth and potentially even triggering a recession. If it moves too slowly, it risks letting inflation become entrenched, eroding purchasing power for households across the country. We're seeing this tension play out in the financial markets, with bond yields rising and stock market volatility increasing as investors try to anticipate the Fed's next steps. The coming weeks will be critical as we await the next Federal Open Market Committee meeting for more concrete details on their plan. Shifting gears from the broader economy to a specific sector, let's talk about technology. Despite concerns about rising interest rates, which typically weigh on growth-oriented tech stocks, the industry is showing remarkable resilience. A recent report highlighted a massive surge in corporate investment in digital transformation. Companies are pouring billions into cloud computing, artificial intelligence, and cybersecurity. Why now? The pandemic acted as a massive accelerator. Businesses that were slow to adopt new technologies were forced to adapt overnight. And now they're doubling down on those investments to improve efficiency, reach more customers, and stay competitive. We're seeing this reflected in the earnings reports of major tech giants. Companies specializing in cloud infrastructure, like Amazon Web Services and Microsoft Azure, are reporting record-breaking revenue growth. This isn't just about big tech either. Smaller software-as-a-service companies are also thriving as businesses of all sizes seek out digital tools to streamline their operations. This trend suggests that even in a higher interest rate environment, the demand for technological innovation remains incredibly strong. It points to a fundamental shift in how the modern economy operates, with technology becoming less of a distinct sector and more of an integral layer across all industries, from manufacturing to healthcare. So, how do all these pieces fit together? We have a labor market that's tight, with rising wages but a lingering participation gap. We have a Federal Reserve poised to raise interest rates to combat persistent inflation, a move that carries its own set of risks. And we have a technology sector that continues to power forward, driven by a wave of corporate investment. These three forces are creating a dynamic and uncertain economic landscape. Looking ahead, the key question is whether the Fed can engineer a soft landing, that is, can it cool down inflation without derailing the economic recovery? The strength of the labor market provides a cushion, suggesting the economy can withstand some tightening of financial conditions. If wage growth can keep pace with inflation without spiraling upward, and if more people return to the labor force, it could ease some of the pressure. Furthermore, the continued investment in technology could lead to productivity gains, which would be a powerful antidote to inflation in the long run. By making businesses more efficient, technology can help them produce more with less, which helps to keep prices in check. However, there are still significant headwinds. Global supply chain disruptions, while showing some signs of easing, remain a major challenge. Geopolitical tensions could introduce new shocks to the system, particularly in energy markets. And the path of the pandemic itself is still a variable. A new variant or a future wave of infections could easily disrupt the delicate progress we've made. In summary, the U.S. economy is at a critical juncture. The post-pandemic recovery is entering a new phase, one defined by the transition from massive government stimulus to a tightening of monetary policy. The strong underlying demand is a positive, but managing the associated inflationary pressures will be the central challenge for policymakers in 2024. The data we have discussed today, from the jobs report to tech sector investment, paints a picture of an economy that is robust but facing a complex set of challenges that require careful navigation. We'll be here to track every development and break down what it means for you, your finances, and the future of the economy. That's all the time we have for this week's deep dive. We hope this analysis gave you a clearer picture of the forces at play. What are your thoughts on the Fed's strategy? Are you optimistic about the job market? Let us know in the comments below. We read every single one. Thanks for watching, and if you found this video helpful, be sure to hit that like button and subscribe for more in-depth economic analysis every week. We'll see you in the next one.